Hey, people are jumping on the call here. We're just waiting for everyone to get logged in. Brian and Greg here. We're going to get started here just shortly. I'm just seeing folks starting to come in now, so we won't start anything here till the flow here. All right, we'll officially start here at 10:01. I want to respect everyone's time. Okay, we want to thank you guys so much for joining us today. We've not done a live webinar like this before, so we're really excited to test this out. Just a few logistics here. If you have a question, right now everyone's muted. You can't talk, you can't speak. We've got a lot of people on the call, so if you got a question, there is a Q&A button feature that you can go ahead and ask your question, and we get it here and we'll address it at the end. So at any point, if we're talking, if something comes up in a question, just go ahead and type it out and put it in there. You don't need to wait to the end to send the question, but we're not going to be going over the questions till the end. So the format today, we've got about 15 minutes prepared of some things that we're going to talk through, and then we're going to get to the Q&A, and we'll stay on as long as you need us to stay on to get through this. All right, so let's go ahead and get started. All right, so we thought it'd be important to just talk about what has happened. Why are we here? What has got us to this point? Okay, and basically, you know, the fear of this contagious disease has led to a very restrictive government policy on the economy. Okay, because what the goal is here, we're trying to create, you know, social distancing, isolation. You know, how do you not get a disease to transmit and be contagious? Well, then you just stay away from people that have the disease, right? However, right, it's closed just about every activity that requires people to be present. So if you think about our economy, it's essentially shut a good part of our economy down right now, okay? And there's still a lot of unknown, there's a lot of emotion out there, so it's halted a good part of it, right? And as a result now, okay, so, you know, we've seen that we'll get in the markets here in just a minute. The markets have obviously gone down, but we're likely going to see a recession, okay? A recession, you know, 2 consecutive quarters of, you know, declining GDP growth, and, you know, in terms of definition, we're going to likely see that. And we'll just see exactly what, you know, how that all plays out here. So let's go ahead and get into some of these charts.
Yeah, this first one, Brian, we wanted to show just how quick this has all happened. This is actually the fastest move from the market top to a definition of a bear market in history. And we look at all these other ones, they typically, they still, the market goes down faster than it goes up historically, but even still, most of these others occurred, you know, a normal ending to a business cycle, maybe the occasional credit bubble or valuation bubble or something like that. But even the crash of '87, you know, it took a couple months. So this has actually been the fastest move into bear market in history, and exemplifying the shock that the economy is seeing.
Yeah.
You know, these next couple of charts are actually some that we shared on a recent video, but we thought they were so good and we got such good feedback on them that it would be good to go over them a little bit again. So this data tells us that from historically, during recessionary periods, what have stocks done from the peak to the decline on average? About 28% decline. Now, if we look at what we've done already, depending on what, you know, benchmark you want to look at, we've declined 32 to even 40% in some metrics. But as we look out from the trough, whenever that is, whether we hit it this week or weeks from now, you know, remains to be seen. But when you eventually hit that trough, you don't want to miss out on that eventual recovery, because looking out a year or two later, the returns are far, far above normal annual historical returns. So it's tough to time the bottom, and you don't want to miss any eventual recovery whenever that does come. Right. So speaking of recovery, you know, how long does it take to get back to break even? This looks at all the big drawdowns going all the way back including the Great Depression. Now, we don't think that's relevant for a lot of reasons. I mean, if you go back, and I've been doing a lot of reading on that period, it's amazing how much we've learned about policy since then. The Fed was actually raising rates during some of the Depression. President Hoover actually said, not only is there not a depression, there's no recession, and they were trying to balance the government budget instead of provide stimulus. So that's part of the reason, things were so bad then. But if you go into more modern times where we've learned a lot about how to enact policy, the recoveries have been sometimes as short as a few months to a year and a half, a few years. The crash of '87 that a lot of people is comparing this to took about a year and a half to get back to break even. Obviously, none of us know how long it will take, but it's nice to look at history and say, hey, there are periods when it's been a fairly quick recovery.
Yeah.
Now, this is a chart that we actually created ourselves a few years ago, and we did it as part of a white paper that we wrote on called The Greatest Obstacle to Investing. It was all about the behavioral side of investing. And so this is actually the S&P 500, the stock chart, starting back a little after the tech bubble and going all through the great financial crisis. These are just a lot of the emotions that run rampant through investors during the ups and downs. And so right now we're going through a lot of those red comments there. People are scared and afraid and regretting things they've done or not done. And that's all, that's very common. We understand that. We try to prevent that as much as we can. But what we also want to make you very aware of is while you're going through those emotions now, eventually you're going to go through some different emotions, particularly if you panic and get out of everything right now. After this period, if you go back over history, there's a lot of other emotions that come in. I don't believe this, this isn't real. There's going to be another crash. This is just Fed induced, whatever the reasons are this time around. It's good to be aware now of the type of emotions, the type of feelings you may have so that they're not affecting your investing. And again, back to why we have a rules-based plan. We try to cut out as much emotion as possible.
And let's be honest about the emotional state that we're in right now. Okay, not only is there there's a lot of fear about this disease because there's a lot we don't know. There's a lot of fear about the markets and the economy because this is very unprecedented. We can't point to a time where it's like, oh, well, if we go back to this time, boom, here's the playbook and here's how this happened. And so likely there's some good decisions being made and there's probably some bad decisions being made right now with some of our government leaders and things like that. Because we just don't know. And so there is a lot of emotion right now. But again, we do not want to make emotional decisions when it comes to our money and investing and the markets. So that being said, let me go over a couple things here. And really just kind of piggybacking that is that this sell-off and downturn is external and policy driven, and it was not caused by weakening earnings and economic data. So when you look at some of the past drops that we've had, let's look at our last two bear markets that we had, back in 2000, companies were lying about their earnings and there was just this huge greed push into the tech stocks and you can never lose money in tech and all these things. And then boom, it crashed. We look at 08, 09, there was all this leverage and derivatives and people were just piling into real estate because you can never lose money in real estate, and there was a lot of things that were starting to happen and unravel. What's happening right now, it's not like the economy, there was something brewing underneath that was going, oh my gosh, wait, something doesn't seem right here. The economy's chugging along, things are going great, and this thing comes out of nowhere and policy's enacted and things are now shut down and the market's reacting to that, which is our belief that, if any minute now someone comes out like with a cure or a vaccine or something like that, I'm willing to bet this market's going to rip right back up because there wasn't a lot of underlying thing. Now, I will tell you a concern that we have here is if things continue to stay closed down, then things could potentially go there. And so that's the thing that we're really looking at right now is, is this policy going to stay in place indefinitely? Are we going to start, moving out of it and things like that? And we'll talk about that here coming forward. So but the main thing is we need to keep a longer term outlook. Just as these charts that Greg was talking through here, you know, 1 year later from these troughs, and these are some pretty big downturns here, you know, on average, 1 year later, you're up 32%. You know, 2 years later, on average, you're up 42%. And again, and many times that's months and sometimes a couple years, but we need to keep a longer term outlook. Whether you're young, whether you're retired, your accounts look very different in terms of how they're, but you still need to keep a longer term outlook. All right. Greg, I think you were talking about this next point. Yeah.
Yeah, we also think it's important. Sometimes, you know, when things are going bad, it just looks like a bunch of numbers flashing red on the screen, and you just, you know, you lose track of the fact that these are, as a shareholder, you're actually a partial owner in real businesses, you know, that have real, you know, qualified managements and employees out there every day trying to better their company, better themselves, better their own, you know, living. So don't forget that, you know, whether it's an individual stock or an ETF, you have partial ownership in real companies that have a long history of eventually coming back and even prospering down the road.
Yeah, yeah.
And so there, you know, getting back to some of our charts earlier, this bullet point ties in, you know, the market's history of recovering. You know, if you look at how markets bottom, they typically bottom several months before, you know, the recession bottom. So the markets typically bottom when things are bad and look bad. I mean, the data is going to get much worse economically, potentially even on the health side, of course.
Right.
So the data is going to get worse. Don't, you know, the market knows that for a fact it's coming. But usually markets bottom when things look bad. If you wait till things all look good, the market has gone up a lot. And speaking of things that look good, I mean, it's not easy to find silver linings right now, admittedly. But China, of all places, has actually said production is back to 80%. The CEO of FedEx recently said they're seeing better business there than they expected. So it shows that, you know, we can get past this. How long it will take, obviously, it's, you know, difficult to evaluate right now, but eventually we will get past it.
Yeah, and we want you to know here from Parallel Financial, look, this, you know, we're not into what's going on here. It's not like we're some third party that's managing people's money and investments and things like that. You know, I mean, our revenue's been negatively affected by this downturn. You know, thankfully, this is what we do for a living, and we've, you know, we're well prepared for that. Our personal investments are invested right alongside the same strategies that our clients are. So we're right here with you going through this just as well. Okay, so I think it's important to know we're not just kind of hovering out here, you know, and this is your money. We're right there with you. We experience a lot of the same emotions as well. Thankfully, we do have rules in place to keep us from not making emotional decisions too. So what are we doing? All right, let's answer that question. So we're using this as an opportunity to reallocate assets to areas that could potentially benefit when this environment changes. It's going to change. It will get better. And so what is going to do well when we come out of this? And we are spending a lot of time looking at that. You know, if you're a client of ours, you're seeing things happen in your accounts as we reallocate and do that. We're at, you know, there's a lot of great, as Greg was saying, these are great companies that have strong balance sheets that are just came down with the mess like everything else. We're looking to add to some of those positions and take advantage of some of these lower prices. We're doing a lot of tax loss harvesting right now, especially in our ETF strategies, because you can own one S&P 500 ETF and you can sell it at a loss and buy another S&P 500, and essentially you're fully invested, but you've been able to realize some of your losses. So we're looking at that and doing that as well. And we're gradually putting cash to work. We do have some cash in various strategies on the sidelines, and we're dollar cost averaging in. We don't know where the bottom is going to be, so we're not going to try to pick it, but we know that if we move a little bit in here and there, we're going to come out of this good. And so how are we positioned? Greg, why don't you take this?
Yeah, so, you know, of course, we're trying to take advantage of things that have good longer term secular trends, and some of it ties in with benefiting from some of the things going on now. We won't mention specific names, but we think the healthcare space particularly is interesting. It tends to be defensive. It tends to be, the valuations are pretty good there. We think, there had been a lot of talk about, drug pricing getting hit and all that. We think that's on a back burner right now by Congress. They got other things to worry about at the moment. We're looking at, on the technology side, a lot of companies that benefit from cloud. People are using more and more data, and it needs to be stored, and companies need to have ways to transmit all that data. We're using virtual technology solutions. And then on the communication side, no one's stopping use of their cell phone or their internet or using the cell towers. So we're trying to find areas there that remain defensive but still have good longer term growth prospects. And so what are we avoiding? Some of the things that we've already been avoiding. I mean, low quality. I think it's really important to use a quality screen always, particularly right now. Some of those low quality companies could have difficulty during this period. The energy space, we've long been bearish on the energy space, and that isn't changing now. Travel related is hit or miss. Obviously, it's dramatically hit right now. There could be some comebacks. And some of the lower quality retail. A lot of these things that have gotten beat up so much, when the market surges, they may have a temporary bounce and it may be large. But we don't typically want to go bottom fishing and try to buy what's been beaten up the most. I mean, usually that's happened for a reason. They're lower quality, maybe their financial statements are not good. Occasionally you can find the great potential return down there. It's not that it doesn't happen, but we prefer to buy something that's held up on a relative basis because that's a good sign for their future.
Yeah, and one thing I will say, because we're getting calls like, hey, Brian, should we be buying cruise lines right now? I mean, they're so beaten down. Brian, should we be buying this right now? And again, be very careful buying what has gone down the most. Greg mentioned energy. Energy's been in a bear market for years, and this is continuing that. And they're going to continue to pump oil. There's a price war. They're trying to drive prices down right now. So while there could be some bounces and things like that there. Again, just be very, very careful. Just because something's gone down the most doesn't mean it's going to come back the most. All right.
I would say that ties in with our rules-based system. I mean, there's no question you could be fortunate and get one of those things that have been beaten up a lot. But to us, that's speculating. That's not our preset philosophy and rules-based plan of how we invest. So yeah, you can take a stab at one of those things and maybe you'll be fortunate, but it just doesn't fit our philosophy. It's more speculating than investing.
Right on. So what you can do, all right, and just a few things here, we'd say, let's use this disruption in your routine to reconnect. Just sharing personally, been working from home here most of the week, and as our family, we've been having dinners together every night. There's no activities going on. We're not having to run here, drop the son off here, do this, do that. And I got to tell you, it's been really nice reconnecting. And obviously what I do, I'm focused on the screens a lot during the day, and it's been a nice way to reconnect and do that. So this is, all of our routines have been disrupted. It's a great opportunity to reconnect. We'd also say just take care with headlines, news, social media. I've heard a lot of people call me up and say, well, Brian, they're saying this, they're saying that, and I'm like, well, who's saying this? And where did you find this? And what is this? There's so much stuff that's just getting pumped out right now that a lot of it is just not, it's not necessarily accurate or right or anything. So please just, take care with that. Maybe, take it with a grain of salt. One of the things we're trying to do here is support our local businesses, especially retail, restaurants, things like that, if you can. And maybe they're closed down, but if you've not personally been impacted financially, and maybe buy some gift cards or something, because I can tell you these business owners are dealing with some cash flow issues right now, big time. And one local restaurant group here in town, I just found out yesterday, they furloughed 300 people in their thing, because it's like, well, until further notice. So if there's a way that you can potentially do that, help others. One of the organizations that we do a lot of work with here at Parallel Financial is called Project Host. I actually sit on the board there, and it's a wonderful organization. They've been serving meals 6 days a week since 1981. Anyone, doesn't matter if you're rich, poor, old, young, whatever, you can go in there every day, 6 days a week, and get a lunch. I'll go ahead and pull this down here real quick. Let me escape out of this and see if this will come through or not. But well, maybe not. There we go. Okay. So they're right now they are actually ramping up their food production and service. But the challenge that they have is they can't have volunteers come in and prepare the foods, because that's typically what happens. Because again, you know, with the quarantines going on right now, so their staff is just in there putting out these meals. They're doing bag lunches now every day. So if there's something, you know, we'd say, so what we're doing here at Parallel is, if you go to their website, projecthost.org, and make a donation, and in the comments put Parallel Financial, we will match your donation for Project Host. But it's a way that we can help our community and do that. So thank you for letting me also share about that as well. And so that brings us to the end of our presentation. So if you have any questions, again, there's a few that have come through already that I've got here, but if you want to go onto the app and type out your questions, we'll be happy to answer them. All right, let's go ahead and get started. Greg, here is a question. I understand, this comes from Mary Sue. I understand that oil dropped dramatically. How do you see its effect over the next 6 months?
Okay, are you hearing me okay? My microphone just cut off a little bit there.
Yeah, I can hear you just fine.
Okay, great, just making sure. So oil, yeah, so obviously there's a couple of things that have happened with oil here recently. Obviously what's going on with the economy and the recession and all that. But at the same time, Saudi Arabia and Russia, two big oil producers, got into a dispute. And so Saudi Arabia has dramatically ramped up their oil. I mean, on one hand, you can say that the declining gasoline prices and oil prices are good for the economy, but also there's going to be a lot of oil industry workers, which that industry has increased in size for the U.S. here. That industry is definitely going to be struggling and losing a lot of jobs. So there's probably a balance there that you want to see oil trading at. You don't want it so low that that industry is having to lay off a lot of workers, but a modest decline in oil is fine to help the consumers. So hopefully we'll find that balance as we go forward.
Good deal. All right. Here is another question. Do you expect the government to bail out the corporations that have lost money due to the virus? How do you see its effect on the stock market?
Yeah, we've been reading about the stimulus plans. The one that's being worked on now that probably will get through next week is the one where they're talking about, you know, who they're going to bail out or how do you want to word it. Certainly the airlines obviously are the big ones that they're going to help, but there is talk. The last I saw, they said there'd be related industries that could receive some assistance. They haven't spelled out exactly how it's going to work. If we go back to the financial crisis when they bailed out, you know, the banks and some other industries, auto, those industries ended up paying that all back plus interest. So we're assuming it will be set up the same way, but the details haven't been released yet. So, I mean, at this point, you know, it's really subjective whether you think that's needed or not. Certainly the airline industry is probably pretty vital to the economy as a whole. So that's probably why they're focusing on that space above others.
Okay. Another question from David. How is the bond market holding up as compared to the equity markets? I can start this, and Greg, if you want to add something. It's holding up in terms of, you know, the volatility and coming down better than the equity markets, but the credit markets have experienced some pressure downward as well. You got to remember, when we think about interest rates and government bonds, you know, that's what we call like the flight to quality, but there's still there's mortgage-backed securities and high yield debt, and there's regular corporate bonds and preferred stocks, and there's so many other areas of the fixed income market, and those have been pressured down. Granted, it's a lot less than the stocks have, but there's still some pressure there. Greg, you want to add anything to that?
Yeah, I mean, we saw early on in this, we saw rates just drop exceptionally fast, and then they've spiked back up quite a bit. I think that part of what the Fed is doing with their quantitative easing and all their cutting rates is to try to stabilize things on the liquidity and credit side, and that's what the Fed is doing. They know that, you know, this is a different type of recession and sell-off right now, where the Fed can't necessarily stop it per se, but they can provide liquidity, which is vital to keep, you know, the financial markets operating properly. the Fed said last Sunday they were going to do $500 billion of purchasing over several months. They're going to do more than half of that this week. So they're going to be doing a lot. And so once we get past the real crisis period here, that liquidity is going to stay in the market for a while, and that will be a real positive eventually.
That's one thing that we didn't really mention in the presentation, Greg, is that, and I think we've mentioned it in prior ones, but central banks around the world right now are just trying to create as much liquidity, make companies and access to money as easy as possible. And so, you've heard the statement, don't fight the Fed, but they are putting as much liquidity into the system as they can, and just trying to keep it there. And that usually when that happens, it benefits asset prices like stocks and things like that. So that's something to keep note. All right, we got another question here from Kenneth. Will the current situation change our investment strategy for the U.S. market or international markets? In terms of an allocation, I think we're still, we still have weighting in international. That's not changing at this point. We're not, again, what we're really shifting more, it's not necessarily a U.S. versus international as much as it is what areas do we think that are going to benefit with what's happened and going forward. And some of them may be, some of these companies are multi-international global companies, but we still think, matter of fact, recently, just probably may not seem that way, but the emerging markets have actually been responding, especially this past week, even a lot better than domestic has in some areas too. So we're still going to own those areas, and we're still going to look for opportunity there. But we're really focused more on finding what industry groups, sector groups, things like that we want to try to either have a little more exposure to or less exposure to in that regard. Do you want to add anything to that, Greg?
No, I think that's right. We make tweaks around the edges, but back to just kind of sticking with our overall philosophy, we're not going to make big wholesale changes. I mean, certainly if you look at the data, valuations internationally, even before this crisis, looked quite a bit cheaper. But valuations aren't always necessarily a timing tool by any means, but it does offer reasons to have some exposure.
Yeah. Okay. Any other questions here? We have got through those. All right. Well, no other questions are coming in at this point, and we're hitting the 30-minute mark. So why don't we go ahead and just, we'll go ahead and end it here. If you do think of another question, or you've got something you want us to address, here's our phone number, here's our email addresses. We're available, and we would be more than happy to talk to you about your question or even your particular situation with your portfolio. So thanks again, everyone. Really appreciate your time today. And as we get into this weekend, just enjoy this weekend the best you can and reconnect. And we'll be here if you need us.